potential range within the market can be expected to trade that next day, and that range, of course, in an intraday strategy is what we're going to be trading. Again, to get down the time frame, to make it a little bit clearer what we're doing, we're going to focus only on the last month and talk about the last month in a little bit of detail. The strategy that I'm going to use is, again, it's kind of in development. It's not the type of thing that is necessarily, a completed strategy being refined. It's probably more in the neighborhood of, the idea of giving you some things that you can look at and kind of consider in your own research and your own analysis as to what might work best in your own trading strategy. These are only kind of a clue as to what we can look for. So when we look at this strategy, we are going to first of all, if the indicators that we have here, if that evidence is bullish, we will only trade intraday from the long side. We'll only be buying. If it's bearish, of course, then we would only be trading from the short side and trying to find a spot to sell. If we are buying, our goal here is to fade the predicted low with a limit order to buy $1 above the predicted low, or 2, because sometimes the markets do pull some breakouts above the highs and lows and so forth, we're going to buy $5 above the predicted high. Always keeping in mind that we're going to risk no more than $5 or $500 total for a full size, or $165 for a mini contract in gold. This gets maybe a little bit convoluted, but we'll explain it by hopefully looking at some of the bars day-to-day, candles day-to-day, and kind of go through what you can look for on a chart as to whether you'll trade. We're going to start with our way over here on the left-hand side. We're going to start with this candle right here, which is on March 15th. When you look at that candle and you look at the various indicators, what's happening on those indicators, you are judging this indicator, this candle rather, to project what you're going to be doing the next day. So looking at this indicator, we see that we have several different clues as to what's happening. First of all, we have a situation where the predicted high, or the Neuro Index rather, is suggesting 1. That's a plus. We have a situation where we have basically a 0 in the predicted medium-term difference, a negative in the predicted long-term difference, and when we look ahead to what's going on the next day, according to the projections that we have, of course, we don't have the predicted moving average yet because we have to have that day's data before we can get that, but we do have the projection that the next day's predicted low will be higher and that the predicted high will be higher. So putting all those together, when you net those all out, if you assign numbers to them and you want to go through this routine, you can then come up with the possibility of being long, and it's not a convincing case, but it's a case that leans to the long side, the long disposition in an intraday trading type of situation. Our strategy will be, as I said, we're going to, if that's the case, we're going to try to fade that low by just $1. This predicted low that we have here, right in this position right here, we're going to try to fade that by $1, which would put it right in here somewhere. But the problem that we have right there is that it never got there. So this time we're going to go to our alternative buy scenario, and that is we're going to buy $5 above the predicted high. Predicted high was at 11.12, so we add $5 onto that. That would put our buy signal somewhere in the vicinity right in there or so. And again, these aren't exact, but just to give you an idea, it's going to put our predicted buy at 11.17. Now we have several ways. Once we're in this market, we're not really looking to be trend followers. We're not trying to establish any kind of long-term position, although this type of a breakout is one that we have used in other webinars to describe what a long-term position to start would be. But in this case, we are looking for only a day trade. So we have several possible places here at which we can act to take our profit. First, the high here on this particular day was right around in here at 11.29. I guess it was about $12 higher than our entry spot. So we have a choice. We could take our profit at $10 profit, which is $1,000, which isn't too bad since we're not trying to establish a long-term position. But we're going to see our opportunity here to take $1,000 and probably be happy with that, and we would get out, that profit. Or we could sell on the close, which close was at 11.22. Still a profit, not as big as the other profit. It depends on what your type of strategy might be to get out of this particular trade. So this one would have been profitable. So when we talk about some of these strategies, I don't want to give you all the impression that it's going to be everything is always going to be coming up perfectly and profitable and so forth. So we want to talk about this next day's candle. That candle that we have right here, again, we're using this candle right here, the March 16th candle, is now going to kind of provide the clue as to how to trade the next day's trading. See, now we have most of the indicators. We have the predicted medium-term moving average. We have the index. We have the predicted difference. Everything there is pretty much pointing to the plus side, so that in this case, we would want to be looking at that trade the next day from the long side and trying to establish, a position on the long side of the market. This particular candle right here that we're trading. Now, in this case, it didn't work so well, but you got a strategy, you got a system, you kind of got to follow it through. Again, I'm refining this. Maybe this isn't exactly what I would do after some study, but this is kind of where we're at today. The expected range on March 17th then would be from predicted low at 11.22 and the predicted high at 11.27, which is in this vicinity right here. Within that range, now we obviously can see that the candle did not get down to the predicted low, so we do not have that buy opportunity $1 above the predicted low, but we do have the opportunity again on that breakout. We're going to trade the breakout. We're going to make it go up $5. We don't want to get faked out too much, but we're going to try to make it go up $5. And so at our 11.27 that we said was our predicted high, we would be buying at that predicted high plus $5, or at 11.32, which is about right in there. There is, of course, a situation that the market did not go up. The market did go down, and as I said before,